In this final video, we will briefly cover the 2008 global financial crisis. When you start entering the labor market, you will soon notice that this is an issue that's still very much in people's minds. For most of the current workforce, the 2008 recession was by far the strongest downturn they had encountered prior to the COVID pandemic, and it still very much shapes our thinking about financial markets. The origin of the crisis is a little difficult to pin down exactly, but it followed decades of financial innovation, especially in the areas of structured finance, including instruments like mortgage-backed securities, collateralized debt obligations, or credit default swaps, dating back to the 1970s, but picking up more steam in the 1990s and then especially the early 2000s. The Glass-Steagall Act, which barred depository banks from investing in certain types of risky investment activities, was repealed by Congress in 1999. In response, traditional banks and the government-sponsored enterprises began participating in large-scale originate and distribute operations, which led to the mass expansion of subprime credit, that is, mortgages to borrowers of questionable creditworthiness. The issue was exacerbated because the large ratings agencies, S&P, Moody's, and Fitch, issued stellar ratings for much too risky assets, and other firms like AIG then issued insurance on this basis. In consequence, a housing bubble formed in the United States, and after the Fed had started to raise interest rates in the mid-2000s, that bubble burst in 2007. That in turn caused a mass deterioration of financial system balance sheets and a run on what is called the shadow banking system, a hard-to-define group of smaller intermediaries like finance corporations or hedge funds with significantly less regulatory oversight. In a similar vein, Bear Stearns, Lehman Brothers, and Merrill Lynch, three large investment banks, either went bankrupt or were assumed by other banks. The credit boom in the US mortgage market is hard to overlook. From 2000 to 2007, the mortgage volume in the United States more than doubled, far ahead of annual GDP growth or population growth. It is also evident that this expansion was much faster after the repeal of Glass-Steagall in the early 2000s than it had been before. With the share of subprime mortgages originations in the late 1990s were effectively around 0%. It was the GSEs that pushed up a lot of this additional debt into the market. By 2005, about 20% of new mortgages were in this risky segment. Lending practices were often obscure, and some borrowers would take out loans they would never be able to repay and that they hardly understood. When the Fed tightened rates, many of these mortgages could no longer pay interest, sending the housing market spiraling. Now, I showed this graph earlier. This is once more the Schiller Home Price Index. But notice that the housing price segment starts falling way before the crisis sets in. It really starts around 2007. This is because housing is a comparatively small share of GDP. It's only about 3 to 5% in any given year. Only when these losses started to come back to banks' balance sheets in 2008 did this become a broader crisis. The crisis itself then peaked in 2008 with the bankruptcy of Lehman Brothers and the assumption of Merrill Lynch by Bank of America within the same week. Mortgage delinquency increased by about a fivefold during this period, sending both financial system assets tumbling, but also putting a heavy debt burden on households in the early stages of last recovery. However, thanks to low interest rates throughout the decade, after 2013-2014, delinquencies came down, household net financial burden came down, and now actually looks better than it has done at any point in history coming into the current crisis. With delinquencies during 2008 came a decline in asset value. This is particularly noticeable in the early stages of the recession. After that, Congress provided bailout funds to banks, and the Fed expanded its capacity to act as an emergency lender during much of that year. Even so, prior to 2010, much of the credit market froze up almost entirely. And a lot of this, of course, has to do with these write-offs we mentioned earlier. Much like during the Great Depression, the general squeeze also sent stock markets tumbling. This here is the Wilshire 1000. This may not be an index you're as familiar with as the S&P 500 or the Dow Jones. It's a very broad index. It's one that I often like to show because people don't know it quite as much, and it gives you a better sense of broad corporations and not so much as the 500 big ones or just the industrial ones like the other ones do. One thing that is different from the Great Depression, though, is that the stock market wasn't the trigger. You may recall that during the Great Depression, stocks tumbled first. That affected the general economy and eventually banks. Here it kind of worked the other way around. The stock market does pretty well until banks start to choke up, and then it tumbles down. Again, it took almost 5 years to recover, although it did so faster than during the Great Depression. Finally, corporate bond spreads, as is to be expected during a financial crisis, widened as well. While other financial stress measures peaked a little bit earlier, though, the depth of the recession kept spreads elevated until around 2012. And that really indicates just how much more difficult it becomes for corporations to obtain credit after a financial crisis. And just in comparison, because we have 2001 too, 2001 was a minor stock market crisis. You can see that corporate spreads started rising. They do that still until about 2003. But the widening here is about from maybe 3% to 4%. In 2008, we started around 2%, and the spreads tripled. Right? So it is a much more significant shock for the corporate sector than the 2001 stock market crash was. That's common for banking crises. Banking crises are much deeper shocks than many other financial events. Now, what was the policy response? How did the crisis unfold? Just in terms of magnitude, the US economy contracted by in 2008 and then especially in 2009. And real GDP in 2009 fell by about 2.5% over the year. This is comparable and probably a little bit milder than the projected figures for 2020. So both of these fairly deep events. At that point, it was the largest recession by that metric since the 1940s. The following expansion was long, and especially from 2012 to 2014, it was pretty decent. But in the earliest years, it was the slowest post-World War II recovery on record. Unemployment and housing did not recover very strongly before 2012. At the time, there was talk about the jobless recovery. Of course, eventually we got out of that. But even so, the magnitude of the 2000-2009 recession was smaller than the Great Depression, in part because the policy response was completely different. As early as 2007, the Fed injected markets with liquidity to prevent a financial contagion scenario, cutting rates to zero and creating several unusual emergency facilities, some of which have been renewed in the context of the current crisis. At the same time, the Treasury provided additional help through the Troubled Asset Relief Program, or TARP, in 2008, and a comprehensive stimulus package in 2009. Congress then further passed the Dodd-Frank Act, a significant piece of legislation, which dramatically changed the way in which banks are regulated. Prior to the financial crisis, banks were mostly monitored at a relatively small scale in what economists refer to as microprudential level. That means regulators observed individual banks, figured out what their assets were, what they could hold, where they would lend, and so forth. But that was it. Since then, the focus had shifted more to what we call a macroprudential supervision, which means comprehensive rules. For instance, the government now observes lending practices under consumer protection aspects. We talked about this notion of annual stress tests, where the government will provide a scenario of macroeconomic proportion, and banks then have to illustrate if they have enough capital to brace such a scenario. There are additional rules, for instance, of how large-scale defaults of illiquid banks or insolvent banks are handled, and so forth. Now, this comprehensive response made the crisis much cheaper than the Great Depression. Once the dust had settled, the economy recovered much faster. Definitely not a 6-year period. It was really more one. And all things considered, the cost to the taxpayer was also relatively low, typically estimated to be in the range of somewhere between 300 to 500 billion. Macroeconomically, that's not an exorbitant sum. There are several studies that will give you more information if you're interested in the 2008 crisis. A lot of this has obviously been written and published. And in general, when it comes to all things banking, what I recommend is the Bank for International Settlement, which is a great data source and great source of research. And I included a link here for your optional reading pleasure if you want to learn more about the 2008 crisis.